Wonderful. As you all have questions throughout the content this evening, I encourage you to toss them into the chat. I'll be helping to monitor the chat and raise them to Jackie's attention as we move through this evening's session. So please do utilize that function to your advantage. And without further ado, I'll pass it over to Jackie to get us started. Thanks so much, Jackie.
Yeah, thanks, Nora, and thanks for having me. It's fun to be back, and I had a great time at VCIC, so always excited to be a part of the process. This is the first time I'm doing this particular talk, so I do want to let everyone know that if you have questions or I'm moving too fast or too slow through slides, please throw it in the Q&A. There's a lot of text on here and I might not cover it all, so if you have questions or see something, please do let me know. I've built this session around essentially the core of VCIC. I know it was more targeted to, to sort of drafting and building term sheets. That is such a small part of the grand scheme of finding a deal and getting one done. And so I wanted to make sure we had covered, more of that sort of core deal process. So that is everything from the diligence process, building rapport with entrepreneurs, certainly building a case, presenting it to the investment committee or partnership to get it to the point of building and negotiating a term sheet. A lot of this is focused specifically on VCIC because I think Nora, it's this week. So I think it's a relevant time to be covering it. So essentially diligence, investment committee, deal work. Those are, kind of the live days during VCIC, so a lot of parallels there. Nora did a great job at introducing me. I work at Hyde Park Venture Partners. We have, very close ties to Booth and the university. We tend to get involved in seed and Series A companies. So again, this is very similar to the stages of companies that you'll be looking at through the competition. We have a geographic focus and are investing out of our third fund. It's a $100 million fund. Me personally, I've been with Hyde Park for just under 5 years now. And fun fact, I met Guy at VCIC, which is how our relationship started and I joined the firm. So jumping right into diligence, there are, I would say, two phases of diligence. One comes before you commit to the investment, and then the other one comes after. And the difference is in the initial phases, you're really screening companies, digging into their business models, digging into their teams, and figuring out, is this something that is exciting and I want to invest in? This is the framework that we use at Hyde Park when we do our more formal scoring. So things like team, market, we combine that with market or opportunity, evidence of success. For different stages of companies, this can mean different things. Certainly traction, revenue traction, user growth, things like that go into this evidence of success. And product, which to us is a little bit of a catch-all to see, does it have interesting dynamics of, network effects, virality, maybe it's super sticky or frequently used. Some of those misnomers that you might kind of capture in the company. The purpose of this is to really expose, what are the really exciting things about this company, and then what are the key risks, and understand, can we get comfortable with those? And if so, how do we price them into a deal that we're going to suggest? Once you have a term sheet signed, so once you've, agreed with the entrepreneur on preliminary terms, that's when you start asking the question of, can I find something that makes me not want to do this deal? So this is not, are we going to get more excited about the deal? Are we going to, maybe you raise the price, but you're really not looking for like ways to build more conviction. Hopefully you do in the process. But it's essentially saying, are we going to uncover anything, whether it's through, background checks or social media checks of founders, or, maybe at a very extreme case, fraud, or, folks lying or overstating their kind of customer contracts, things like that. You're trying to find ways to sort of validate your initial assumptions in the company. Now that all leads to formal legal documents. You'll have to remember that a term sheet, though it is sort of an agreement of terms, it's not binding. So either party can back out at any time. We'll get into this later. There's one term that is binding usually in term sheets, which says, you can't shop it around once you've signed it, but all the other terms can essentially be renegotiated in this post-diligence phase. All right, so quickly on a case study, and hopefully we can set this up for some participation. Otherwise, I'm going to ask Phil and Ryan to jump in. But a quick case study. This is a company that is, I would say, similar to anything you might get in the real world or in VCIC. It's essentially a marketplace for used outdoor equipment. I don't know, tractors, drills, whatever. And you can post them on the site. The company takes a cut of the transaction, and it functions a little bit like a verticalized Craigslist. The CEO has a lot of domain expertise, worked at DeWalt, which is essentially equipment manufacturer. She launched their e-commerce platform, so a lot of, domain expertise. The CTO, Jill, was the first engineer at The RealReal, which is another marketplace. They launched this time last year, launched 2 years ago, ended 2020 with 5 million in GMV, and they're live across a couple different ecosystems. So this is a quick snapshot. Obviously, as you get deeper into diligence with companies, you get a lot more information. But you really want to focus on, what are the key questions about this business? Maybe Phil or Ryan, can you jump in with one or two? Or if anyone has other kind of ideas, feel free to raise your hand or just unmute and jump in. We'll see.
Yeah, I guess I can go quickly. I'm going to ask why this, platform is kind of needed or differentiated from sort of, the Home Depots of the world that already sell used tools.
Okay, differentiation. Anyone else?
Other competitors?
Okay.
The team looks strong, but how well can they work together?
Okay. Those are great questions. So we have differentiation, competition, and how well the team works together. Any idea for which of those questions you should solve with the team in, either a Q&A environment or in the real world in a deep dive with the team versus, what you should create your own perspective on beforehand? So maybe I'll throw it, Ryan, for differentiation. Do you think that would be something that you should work on and create your own perspective, or is that something you would bring to the team?
I definitely want to work with the team to understand what their product is, but I think you should be doing your homework kind of outside of the meeting, learning about other competitors in the space, and not, asking the company to compare and contrast themselves with their biggest competitors. Yeah, I think that's right. I think this one is probably the harder one and a little bit more nuanced, because unless one of us comes from the industry itself, there might be nuances to different platforms that we don't know are important to the end customers. So certainly working with the team to uncover, why did they build the platform the way they did is important. If you can get in front of customers, either potential customers or current users, which, you don't have time for in the simulation, but you do in real life, that can help drive out some of those. On the competition front, that's certainly something that you'll want to come prepared with on your own. I think it can be a little off-putting early on in conversations to go straight to the competitive set. And seeing how the team works together, I think that's something you certainly learn over time, interacting with the team. One of the questions we ask a lot at Hyde Park is, how did you meet each other? Did you work together in a previous life?
Are there different people that can reference your work styles? So I'd say those are a combination as well. The reason I bring this up is because in the VCIC itself, a lot of times teams waste time on questions that they should have either answered themselves or at least done the legwork to be able to ask those teams. So that's on this kind of third bullet point here. There are a hierarchy of questions. So which are the questions that would make or break the investment for you? Those are the highest priority questions. So if we look at, let's see, like a pre-seed stage company, let's say it's still this Secondhand Garage, but they were doing, I don't know, they've done 50,000 in revenue, right? They've had 10 transactions, something like that. You wouldn't ask them what is their CAC to LTV. That might be really important if they were doing 5 million in transactions and there were hundreds of them, and you could start to measure repeat behavior. But the CAC to LTV isn't going to make or break your investment at that stage. So you really want to tailor, what are those key items that drive decisions? Again, what information would you have gathered beforehand versus, needing to waste that time with the entrepreneurs to ask them, kind of do the homework. And then the other things you want to focus on are just like, where are the holes in your, in your conviction or in the investment memo? Sometimes there are just things that you don't know. So maybe it is a company that, there was a CTO listed on LinkedIn, but you haven't met them. Are they still around? It's not addressed in the materials. That's something that you might want to ask head on. I'll skip back to the first bullet point, which is important, and I would say in real life is amazingly important and can win or lose deals. I think in the competition, different judges view spending time on building rapport with varying levels of support, but certainly you want to be friendly and direct and honest and upfront. Just be a good person with entrepreneurs. You have to remember that if you win and eventually go negotiate a term sheet, you want that person to be thinking highly of you versus like, oh man, it's this team again, and come into the negotiation combative. So this is really where you start that foundation. And then skipping to the third bullet point, the other thing you never want to go into a negotiation without is the other party's expectations or what their kind of like key issues are, right? So always make sure you know what the last round was or how the last round came together, what the price was, if there's a board, all that kind of stuff. If you can get the information out of them of, what is the deal that you expect, what would make you excited, ask all of those questions because it's only going to make make it easier going into the negotiation. The other thing that is absolutely not like real life is that the judges all get to see the information shared with all the other teams. So you might have someone ask this information and the judges will know, hey, they expect a $10 million valuation and you're offering 5, way off base, and they'll kind of knock you for it. So, very important in getting the deal done in real life, but can be, a hit or miss in the competition. I'll pause there. Any questions? I'm talking fast and kind of powering through.
We don't have any questions in the chat. I encourage folks as we keep moving along, if you have questions, please do toss them in the chat, or when we come to these times of pause, you're welcome to raise your hand if you prefer to come off mute. But with that, I think we can go ahead and move forward. Thanks, Jackie.
Awesome. Thanks, Nora. I also just needed like a break to catch my breath. Okay, so moving on to the second part or the second phase of this presentation is the investment committee. So you usually come to investment committee, and different firms have different processes for, when this comes to happen, what needs to happen before that, what happens after that. But it's usually, hey, I know I want to do this deal. I want to invest in this company. And so I'm going to formally bring this forward to an investment committee. Usually firms prepare a formal memo that can be something that is as formal as a standard, Word or PowerPoint template with different fields that you need to fill out, or it can be as casual as a, here's the entrepreneur's deck and here's my, one paragraph on why we should do it. But it usually boils down to, here are the key highlights, here are the key questions, and here's why I think that we can overcome them. Before you issue the term sheet, the partnership will take a vote. And I think this is pretty universal. The scoring systems change, but typically everyone votes because it forces people to take a stand on whether they are excited or not about the company. And that's what essentially enables any partner to do the deal. Some funds say you can do the deal if you have a lower dollar threshold, like, hey, you don't need to come to the partnership if you want to write a check under $1 million, but if you're going to write a check, 1 to 20 million, you need formal partnership review. But there are different thresholds, but essentially it all comes down to a very, very similar process. And this is also when the terms themselves that you're going to offer are typically approved. So, you might get approval for a deal if you're going to offer 20 million on a $60 million valuation, but you won't get approval for that same, to invest in that same company at $100 million valuation. So this is also where the deal itself gets approved. From a VCIC perspective, few like quick pointers on all of this. The partner, I think it's called the partner meeting, something like that in the competition itself. It's essentially where you come and present both the companies that you passed on and the company that you are choosing to invest in to the judges. First, just pick the right company. If there is a hardware company that makes, that makes custom shoes, maybe that's not so venture scalable, but if it's going up against a, SaaS for, shoe supply chain, that might be closer to venture backable. Don't try to get creative. Just pick the company that seems like it fits your investment profile that you are given as a venture fund. Make sure you really convince folks that company is the company that is going to, essentially return the fund or create outsized returns for your fund. When you're going through the presentation, if you make a mistake, and this happens to every group because term sheets are, I make term sheet mistakes and have my colleagues correct them all the time. If you make a mistake, own it and correct it. Digging in and trying to, figure out a logical way around it ends up wasting a lot of time, and I think turns judges off. So make sure, you own it, you figure out what the right thing is and move on. These are just suggestions, but I think they generally run well in meetings, which is, make sure that each person knows one topic really, really well so that you can go as deep as any judge wants to go on that topic. If it's easier for you guys to, pick one person to hand off questions or keep things moving, I've seen that work. Certainly practice the Q&A in advance. It'll help you gain more conviction in the deal, but also, give you more of a preparation for what that kind of Q&A is in the room. It tends to be fairly fast paced, and people will, dig into these seemingly random aspects of the business just to see where you'll take it. This last part is a little bit of a disclaimer. In real life, partner meetings are very collaborative. Everyone is trying to get to the answer or, figure out what the key questions are and understand how whether they're too big to overcome. In VCIC, it's really just to test your knowledge. So it tends to be a little bit more combative than real life, but the outcome is the same, which is, is this company a good one to invest in? Okay, on to term sheets. I'll do a quick pause, but we can move on if there are no questions.
We had one question just related to venture profile, Jackie, which I believe is for the purpose of VCIC, students will be given a very high level profile to which their teams should align with. But in the case of VCs in the real world, that venture profile encompasses your investment thesis, the portfolios and industry verticals with which you focus on, et cetera. Is there anything else that you would want to touch on in regards to the topic of venture profiles and how they might play into this topic this evening?
The only thing I would add is it incorporates all of those things, but they should feed into each other. So they are very, very tightly linked. And I'll give you an example, which is Hyde Park raised a $100 million fund. It's because we have a geographic focus, and at the early stages, seed and kind of early Series A lot of that investing tends to be very localized. Once you get to this kind of Series B, or when the checks are at, 10 million, a lot of the coastal funds are coming in and getting those companies. And so, we need a fund that supports, call it $1 to $3 million checks. Well, then when you look at portfolio construction, you say, we're investing early, so we need a bigger portfolio, maybe 20 companies, because, at seed, some get really big and a lot fizzle out. So we need some diversification there. So then that goes into, let's say the average check size is 2, and we reserve or kind of hold back for future investments that exact same amount, so that, I know this is getting complicated, but the average, capital invested into any one company is $4 million. 4 times 20 is, we need to deploy $80 million. There's typically fees on top. And so that's how we get to $100 million. And so it's a bit of a cycle where all of those things are very linked. Your strategy should be linked to your fund size and the portfolio. That will come out in the competition. So you'll just have to create a narrative that matches your investments. And, sometimes it can be a little, they don't align perfectly. Like, the profile you're given is a $200 million fund, but you have all seed investments that you're looking at. You can certainly create a narrative about a carve-out fund, or, we like to incubate companies. So this would be an incubated company, things like that. It's just kind of creating a story where all the different pieces reinforce each other.
Wonderful. Thanks so much.
Well, so moving into the term sheets, I think we're probably close to on schedule to get through all of this. I mentioned this before, the drafting of the term sheet is probably the easiest, or at least shortest part. The hard part is, the diligence, getting to, hey, what is the price we want to pay? Are there different things that we need to take into account, like board structure? How is the entrepreneur going to react to that? A bunch of those different questions that really come out in the diligence phase and are discussed at the sort of partner meeting phase. The actual drafting of the term sheet is just plugging in all of those different ideas onto a piece of paper. Negotiating the term sheet actually takes, I would say, longer on average than I would expect. I would say 1 to 2 weeks is typical for non-competitive processes. It can be much quicker when things are competitive. Post-term sheet diligence certainly starts as soon as you have a term sheet signed, and can last up to a month, really. If you're investing in a round where your check size is smaller than the full round, you'll need to spend time getting other VCs committed to the round. So that can take time as well. The legal documents are a pain in the butt, but certainly need to spend time and reps with attorneys on both sides, making sure that what you put in the term sheet is reflected in practicality in the legal docs, and certainly other things come up that aren't specifically laid out in the term sheet, so that can take a while. And then obviously wiring the money is pretty quick. All right. I'm going to run through some key terms. I know I've talked about a few of these, or at least mention them in passing up to this point. I'll try to be pretty quick because I'm sure a few of you already, or many of you already know these if you've taken some of the classes, but so we're on the same page. Pre-money valuation is the value of the company before you invest. So essentially how you're valuing the company and the progress that it's made. The share price is, that pre-money valuation, and then, it's divided by the number of shares that are outstanding and any options that are either issued or in the option pool. Common stock is what employees own. Preferred stock is usually what investors own. Those come with different rights that are laid out in the term sheet and the legal docs. A liquidation preference is there so that investors are getting their money back before anyone else in the common pool. I think I have a slide on this, but if we don't, we can come back if folks have questions on it. Participation, I do have a slide on. This gives you the ability to both get your money back and participate in the upside. So for some, it's a little bit, of a double dip. And then dividends, I'm sure you all are familiar with. It's just an interest rate on the preferred investment. It's very uncommon for these to be paid out in the venture world. Kind of taking a step deeper into, I know I mentioned options before, shares versus options. Essentially one is actual equity and the other is equity that you purchase. So from an investor perspective, you are buying shares most likely when you're making an equity investment. Employees and advisors, other people who are getting involved from a more sweat equity perspective, even if they have a salary, are typically getting options. Okay, kind of quick primer on the pre-post money. Should be fairly obvious by now. If we have a company that is valued at $7 million before we make the investment, the round size is $3 million. That company is worth $10 million after we invest. Pretty simple addition. Where it can get tricky is on this option pool expansion. If any of you have taken the PEVC lab, there's this exercise with, I think it's probably still there because Jason's still teaching, but where you have these like complicated waterfalls with different option expansions, and if they happen on a pre or post money perspective, there can be some circular logic when you actually calculate it, but usually an option pool, which is the shares that are put aside for future employees, to incentivize future employees, usually that option pool is put in place before the financing round happens. So the reason for this is it's put there for employees that need to be hired after. It means you haven't already hired them, so they're not included in the valuation of the company today. A little bit of a convoluted logic, but it makes sense when you reason it out. The tricky part is the option pool is usually specified as a percentage of the post money shares. So if I say, we want an option pool that is 10% of the post money shares, I have to do the math and say, you know what, we need to expand it to be, 15% of the pre-money shares, so that when we get diluted down by that investment, it ends up being 10% of the post money. You probably won't have to model this out for VCIC, but it can be tricky when you actually start looking at cap tables once the term sheet is signed. Participation, since this is being recorded, you can all look at it afterwards. I would say participation is rarely used. So it is worth learning, but it is not worth learning so well that you're trying to use it in term sheets just to show that you can. Essentially what happens when a company exits and an investor has participating preferred or has invested under a participating preferred structure is that they get their initial investment back, and then when there's any upside, they get their pro rata share of that upside. So in the company that or the example we used on the previous slide, we have 7 million pre, there's 3 million coming in of new money. Let's say we exit for $5 million. So this is not a great exit. I still get my 3 million back, and then I get 30% of whatever capital is remaining. This ends up, kind of giving the entrepreneurs less in a downside scenario. Without participation, we get our 3 million back because of the liquidation preference, and entrepreneurs get their the remaining 2 million. Now we also get more money on a kind of like positive or upside sale. So same cap structure. Preferred has 30% of the company. They invested 3 million. Common has 70%. An exit with participation means we get our 3 million back first, and then our pro rata share of the proceeds. Without participation, it's still that 30-70 split. So you can see how it really cuts into some of the entrepreneur proceeds. Participation is really not common because we're in a seller's market, right? Everyone is trying to be very founder friendly, entrepreneurial friendly, and so this can really create some sort of poor will between between CEOs and their funders. The way people really go about protecting the downside is using that liquidation preference, because then you're very aligned in the upside and protected in the downside. Quick touch on equity versus debt. So all of the things that we just talked about primarily apply to equity financings. People do not like equity financings when they're raising a little bit of money because the documentation and legal process can be a little bit more cumbersome. I still prefer equity because it is clear cut. Everyone knows what they're getting. There's no convolution. The next round, we know exactly what the next round is going to look like and what the impact it's going to have on the company. But debt can certainly be cheaper and easier to execute. I would say for VCIC, try to shy away from the debt perspective. It's not more beneficial to investors, so there's no reason you would propose that unless the entrepreneur was really hoping for a debt facility, or they already had one outstanding. Key debt terms, I'll be really quick on this because I don't think, I hope a lot of you won't be using it too much. There is a term, so convertible debt means, we issue a debt facility, it converts to equity within a certain period of time. A lot of times it comes with interest. We have gotten interest in some of our companies that had debt instruments, but they tend to be the older ones where, I have someone I think drawing on my screen. They tend to be ones that we, kind of made seed investments in 5 or 10 years ago versus the last couple years. So they're rarely actually issued. There's typically a discount that is associated with the debt. Discount can be, 15, 20%. What that does is it protects the investors in the case that the next round is of a low valuation. So when you invest in, like a debt facility, there's a valuation cap. Let's say the cap is $5 million. So you say at the point when my debt converts to equity, it is going to convert at a $5 million valuation. Now, if the next round is done at a $3 million valuation, that's not really fair to you because you took all this risk up front. There's no reason you should be paying a higher price than the people who just invested, yesterday. And so this discount means you can come in at 20% of the value of the current round. Now, if you invested at a $5 million cap and the the next round is done at a $10 million pre-money, the cap stands. So it's whichever is less. Oh, let me see if I can get rid of, Nora, are you seeing something on there too, or is it just on mine?
I am, and I don't believe that I'm able, there we go.
Got it.
Beautiful.
Okay, cool. All right, so, oh, I think I just walked through this actually, which is you take the less of 80% of the current pre-money or the cap of the convertible note, and that's how you come up with your valuation. Should have learned my slides a little bit better. Okay, I think this is the last slide before we go into a mock negotiation. A few key considerations that I don't think you'll have to worry about for the competition, but become really, really important in real life, which is all the mechanics of how the term sheet is executed. A lot of people like to do their term sheet negotiations in different ways, and even at Hyde Park, I would say a few of us like to send the term sheet in advance. Some people like to walk people through it without any numbers in it and then provide the numbers. There are different ways that people approach negotiations, and it's really what you're comfortable with or what you think is best for the negotiation itself. Certainly, you know, if you go in with a low offer or your best and final offer is going to be driven a lot by what the, you know, dynamics of the round are like. If you set a timeline or a deadline on when someone needs to respond or sign the term sheet, all of these things can really have an impact on, you know, whether or not a deal gets done, what price the deal gets done at, how much leeway you give the entrepreneur to come back with different terms. This last bullet line is a very, very important one, and one that I have had to learn personally, which is like how you create a positive and collaborative and a relationship that sets you up really well for working together in the future. You went through this whole process to gain conviction, to build a relationship. You are excited about making an investment. You don't want to turn that term sheet negotiation into like a hostile battlefield, because when you exit, then you have to be friends again, and friends again for, you know, a very long time, since these relationships are very long lasting. So the key question is, you know, how do you do a good job with the on behalf of your firm, but also create a collaborative atmosphere for, you know, for the future relationship. Okay, I have 2 more slides, but I think we should jump straight to the negotiation because we're running slightly over on time. I'll summarize this to say when rounds are competitive, certainly the power dynamics shift. And so you have to shift your thinking on how to win the deal and the structure of the term sheet accordingly. Syndication becomes important when you are not the only one investing in a round. So this is when, you know, you might be investing 5 out of the $10 million round. Who else is coming into that round? You know, can they be helpful to the company? Sometimes they can not be helpful, so you don't want to bring those people in. Either way, it becomes a little bit of its own type of negotiation or own type of strategy when you're co-investing with other VCs. Okay, getting to the case study, we are going to have Phil and Ryan simulate a negotiation, probably in a similar style as this weekend, on the company Secondhand Garage. This is what a real term sheet looks like. I think in the past, you know, we may have negotiated off of this, but given we're all remote, I simplified it into sort of that like front page VCIC template so we can, you know, see the terms easier. With that, Phil and Ryan, I'll turn it over to you to kick it off. I think you guys are ready. So what we'll do is spend about 5 minutes on the negotiation and then pause it for Q&A and a recap.
Okay, we good? Ryan, are you ready?
Yep, I'm good to go.
All right, let's see how this goes. All right, so as you know, Ryan, we've been really excited to get to know you and your company, and we are really excited to kind of present this term sheet to you today. And I'm hoping that the goal of today will be, we'll kind of go through these terms, discuss them a little bit, and then you can sort of take them back to your board and decide, whether or not this is the right decision for you. So I guess to start off, I think the right thing to do would be kind of go through all these terms, and then kind of at the end, we go back and we can chat through them. Does that work?
Sounds good to me.
All right, cool. So I guess the top term, the one that you're probably most concerned with, is evaluation. So, the crux of the term sheet is that we'll be investing $3 million in new cash at a $7 million pre-money valuation, which values you on a post-money basis of $10 million. We did include here that we could, increase that round up another $1 million at the discretion of, the option of the company, so you. And of that round, we plan on taking, $2 million of the $3 million round. As part of the term sheet, we also are, seeking to expand the option pool to 12%, with the goal of being able to use those options to attract kind of the right talent without kind of using too much of that cash. And then on the board, which I'm sure you're, kind of going to be concerned with, we have 5 members on the board, 2 of which, will be common stock, and 1 of which we're reserving for you of the common stock seats. And then, we're requesting to kind of not change, the board already has someone from the Series C, so we'd like to keep it that way. We plan on joining the board as well as one member of the Series A preferred. Right now, we're kind of appointing, Jane Doe to be a member of the board, someone that you've known well and has done a lot of diligence and worked closely with you over the last couple of weeks/months. And then our goal is to also have 1 independent board member, which, we'll kind of select, unanimously, the goal being to have 5 members and to have some balance between the common and the preferred. Then kind of going down to the liquidation preference, our goal here is to have a 1x liquidation preference, non-participating. If the company is sold, however, within 18 months, we're going to bump that up to 1.5x. The goal of that really is to kind of keep both of our incentives aligned. We're investing in a company for the long run with the goal of, making this a huge company and a big exit. And so that's kind of just some additional protection for us on that in that case. And then the rest of the terms are pretty standard. So kind of an 8% dividend, but it's going to be non-cumulative. Typically, those aren't paid out. Anti-dilution will be broad-based and weighted. If you want to talk through what that is, probably not the most important thing, but we can chat through it. And then in terms of other key terms, we would like to reserve the right to obviously continue our ownership and keep it as high as we can. So in the next round, we'd like to sort of maintain that pro rata rate. So I know that was a lot, but do you have any questions, or can we chat through anything?
Gotcha. No, I really appreciate you walking me through the terms. And also just wanted to say, we were really excited to see the term sheet come through for you guys. It was definitely a big moment for our company, and excited to kind of talk through some of the terms in more detail. Before we dive in, though, I did just have one question. In terms of the independent board member, so this is the first time I've put together a board of anyone outside of our company. In your experience, what do you typically look for in finding an independent board member, and how should I be thinking about it?
Yeah, so I think ideally when it comes to the independent, we'd like someone with some industry expertise that can really add a whole lot of value to the company. And, so someone ideally with kind of, years of experience in either tools or working in construction or things like that is probably someone that could add a whole lot of value to the company. And so I think that makes a lot of sense from an independent board member perspective. And the other thing, just to keep in mind, this will be a member that we all select unanimously. It's not like we're going to choose to select the board member for you or anything like that. So this is really to keep balance and also add expertise to the board.
Got it. Okay. Yeah, that was going to be my next question, how we select them, but I think we can get to that at a different time. So thanks for answering those questions. Yeah, I think it'd be good. Maybe we can start at the pre-money valuation. Would love just a little more context at how you got at the 7 million pre-money. Just, from some of my friends who have started companies, we had kind of expected to see something a little bit higher, but I'm just kind of curious to learn more about the thought process behind it.
Yeah, tons of really good diligence went into that pre-money valuation, I'm sure. But no, we selected that, kind of based off of a couple of things. One, just our experience, kind of investing in companies, throughout our geography and our region. And sort of, a lot of the analysis that we did too was based off of kind of, similar comparables that we've looked at. The main thing that we're really looking at though is, kind of trying to maintain sort of like an ownership level that we're comfortable with. And in this stage where you only need a couple $1 million to grow, we're kind of hoping that, we would own, a good percentage of the company at this stage. And so that's kind of how we landed on the $7 million number.
For sure. No, that's helpful context. And I get the idea of using kind of comparables. I feel like we have a super strong team and a really big opportunity in front of us. So again, we were hoping to see something a little bit higher. I guess I understand you guys have to be concerned with your ownership percentages and things like that. If we looked into possibly opening up this round, we have that extra $1 million we can go up to. Would you be open to kind of raising the pre-money valuation if we gave you guys the chance to invest a little bit more money so you could kind of hit whatever ownership targets you have?
Yeah, no, I think that's a very fair point in terms of, we are looking to, especially at your discretion, if you're interested in kind of, adding more to the syndicate. And I think, that's certainly something that we can discuss so we can kind of hit the ownership target that we're looking for. Yeah.
Okay. Yeah, and we'll have to take everything back to, the people on our team and all that stuff. But I was just thinking maybe if we bumped it up to something closer to like 9 or 10 million pre-money, and then if that was an issue on your end in terms of ownership, we could explore the, opening the round a little bit more and giving you guys the chance to invest more.
Yeah, I think there's, certainly room, and it's something that we could warrant further discussion for.
Okay, that sounds good. And then just so I'm understanding the option pool correctly.
Hey, Ryan, I'm going to cut you off for a time perspective, but,
okay.
But great work, both of you. And Phil, I'm going to talk more about the things you did because, that's what we're trained to be. So please don't take any of it personally. You both did a great job. And so everyone else on the call knows I did tell Phil to make a few common mistakes so that we would have something to talk about, because otherwise we would have, nothing to learn from. I was going to make this interactive, but given the time, I'm just going to run through a couple things. First I'm going to start. Ryan, how did you feel as an entrepreneur with the intro, Phil's pacing, all of that kind of stuff?
Yeah, I felt pretty good. I assumed that we would have met before this moment, but yeah, I thought it was good that he did kind of dive right in pretty quickly. So like maybe we could have spent a little bit more time, congratulating us on reaching this awesome milestone that presumably the founders would be pretty pumped about. So maybe we could have taken a little more time doing that piece of it. But I thought he did a good job kind of explaining, the basic terms, the kind of thought process behind most of them, giving me the chance to ask questions and not being super aggressive on any of the terms.
Yeah, no, I think that's spot on. Philly did a great job. I'll call it running the meeting was pretty smooth. You at least did say you were excited about everything in the beginning. So I think that checks the box. I tend to be slightly more dry as well. And so even in, I'll call them real negotiations, this part can be difficult to be both sincere, but also get your enthusiasm across because you are starting on something exciting. I also thought it was pretty interesting that you started the conversation off with hey, let's get to the point where you can take this to the board. because it alleviates some of the pressure from the current discussion you're having, and it kind of puts you both on the same side. If you're like, hey, let's have something that your board's going to be excited about, and we can work together on. I thought that was great. In the beginning, as you were walking through, I would allow for questions on what things are. At the early stages, this is typically the first negotiation for entrepreneurs, and likely as VCs, we've had a few of these. And so, even if you've read the book or your lawyer told you about this stuff, sometimes it can be good just to do the explanation, and it gives you an opportunity to show why certain terms are in there. I think a few examples of that, like jumping down to pro rata, I would have used that to say we are so excited about this company. We are going to want to continue being involved in this. And we just want to make sure you're not leaving us behind, right? Something like that would be a good way to kind of get you guys both on the same side. Another option where you could have kind of shown more excitement would have been on the investment of $2 million. There are two pieces to this. One is, there's $1 million that's open. Where's that going to come from? Is it because you're not excited and that's why you're not giving me the whole $3 million? Or is it because this is such a competitive deal that we want to make room for insiders or others? So I would position the $2 million as hey, this is a big core part of our fund. We're really excited to, if you're stretching, we're really excited to stretch and really lead this deal. Just kind of add a little bit more of the excitement into it. Ryan, I thought your question on independent board members was good, and I think probably doesn't come up so much in VCIC, but the board questions are really prevalent in real life, both what the makeup is and how to appoint them. A lot of times it's something that is proposed by the leadership team but approved by the lead or preferred, or however it's written in, and that can be sort of confusing of who are these people you need to add to the board. So I thought that was it was a good question, and Phil, you answered it in a very real world way. For the competition, you can always make up someone too. You can be we have this CEO of Home Depot who wants to join your board. Maybe not so overtly, but it's, you can kind of flex on the game itself. And I think those were most of my kind of points of feedback. I wrote other things, but I can't read my handwriting otherwise. So great job, and thanks. Thank you for doing that. I know we have about 5 minutes left. Nora, do we have time to go over by a few, or should I try to wrap real quick?
I'm happy to go over a little bit. I know this is valuable information for both those participating in VCIC and otherwise, so feel free to extend if your calendar allows.
Okay, I'll try to get through the slides in the next 5, and then just if there are questions, I can stick around. If there aren't, we can try to sign off on time. So short story of this slide is be prepared for curveballs. So Phil and Ryan seemed like they were pretty understanding of each other's positions. Ryan could have made it a little bit harder on Phil and been like, what? Our last round was done at a 15, and you're giving me a 7, WT, whatever, so make sure you tease out a lot of that information, but also be prepared for the curveballs. We are about to get into option pools. That is one where there can definitely be some tension. Think about who are the key hires that need to be made, and allocate those specifically, and build up to the option pool that you're proposing. Make sure you have those reasonings behind them. Quick mistakes that I've seen in the past, obviously not knowing what the terms are, or putting terms that are out of market in the term sheet. I mentioned participating preferred before, but that could also be I think I put maybe a 2x liquidation preference in the term sheet. That tends to be somewhat out market, especially at the early stages. Another mistake, forgetting the objective, which is to invest and create a partnership and, hopefully be really successful together. So make sure it's always kind of driving back to that objective. And then going overboard on the negotiation. You don't have to show people how smart you are to, to win the competition or to win the deal. It's really about, kind of getting movement on those negotiating points. Finally, and I think we're going to be right on time. I threw a few resources up here. When I went to booth, I didn't even know what VC was. So definitely relied on a lot of online and sort of text to get me up to speed, especially on the term sheet, because it can be complex when you're not used to those. If you haven't read or at least looked at venture deals, I would have that handy. The NVCA model legal documents are also helpful. I believe there's a mock term sheet. There is somewhere else online, and Nora, I'll see if I can get it to you, that I just saw, which was like a mock term sheet with the current trends listed in the term sheet, which was kind of a helpful cheat sheet. The two on the top right, or at least on my screen, top right, Cooley and Fenwick, they're both venture law firms, and so they publish the latest trends in what terms are happening in the term sheets that they work on. And so I would reference those to say, what are the current valuation multiples? What are the protective provisions that people are putting in? And then on the bottom left, there's the PitchBook NVCA Venture Monitor, which is much heavier on the round size and valuation trends than anything else. But a lot of these should give you an idea of, what the terms are and which ones are, in market or being used today. So I think that's all I have, Nora.
Wonderful. Well, thank you so much, Jackie. We appreciate everyone joining us this evening. For those who have to jump off the call at this point, prior to touching on a couple of questions, if the offer still stands, Jackie, to address a few questions prior to closing, we will be circulating a survey that you'll receive via an Airtable link tomorrow by email. So please do fill out that survey. We're building that out into our Polsky process for workshops and events. We appreciate you providing some feedback on this evening's session. A couple quick questions for you, Jackie, just based on some common themes in the chat earlier. You referenced just a moment ago a resource that includes some kind of common trends of what to expect in term sheets. But just given your perspective, could you at a high level address what you would expect to be included in a middle ground if you were, you mentioned there are some more competitive extensions of term sheets dependent on the deal, some less competitive. If we're talking middle ground for a seed round, what are some elements that you would expect to be included in a term sheet of that caliber?
Yeah, it's a good question. So if I look at, I'm gonna use the cheat sheet from what we were just looking at. So certainly pre and post, I would say at the seed stage, we're seeing, something around 30% dilution. So, some of all of this is like a guessing game, and some of it is more scientific. However you come into the valuation, sometimes that's a revenue multiple, but at the seed stage, it's usually just like, hey, this is what everyone else is paying, and so we're going to pay that. Sometimes it's 6, sometimes it's 8, sometimes it's lower. There's a round size that probably the entrepreneur has a plan around how much they want to raise. And kind of the third point in the triangle is ownership percentage and what the appropriate dilution is for people. And so you kind of like have to balance all of those different points until you get to something. But in short, I would say, anything from like 5 to 8 is really appropriate for seed. 30% dilution. So I think if I'm doing the math right, it's like, 2 to 3 or so $1 million rounds. Option pool, certainly has to be enough to attract a lot of senior talent. So maybe 10%, dividends, I don't know what the standard number is right now, but they're only if declared by board. They're not usual. Very simple liquidation preference. So 1x. And And the board, is typically around 3 people. It's, it might be 2 founders in the VC. It could be a founder, an independent, and a VC, but usually the seed stage, you're trying to keep those fairly small and nimble.
Awesome. Thanks so much. And I know through many of the Polsky programs, NVC Accelerator and otherwise, utilizing this safe note is our kind of go-to from an investment perspective. And, doing so to provide as entrepreneur-friendly of terms as possible. How popular would you say is the use of safe notes in the broader VC community? Or what would you suggest as kind of a more popular vehicle in that regard?
So I would say safe notes have replaced convertible notes as the, popular, here's something quick and dirty, we're just going to get it done. I would say a lot of the companies that I'm coming in at like the seed or post-seed stage have had safe notes. Usually it's like the friends and family or kind of like pre-seed rounds where they're like 500,000 or, just something to like get the company going. It's sometimes comes from institutional VCs, but definitely it's coming at the earlier stage. The hard part about safes and convertible notes is it can get tricky when you're investing multiple rounds on those instruments because the terms aren't so clear about what happens when an equity round is put together. And so even though they're very easy to do, they tend to be founder friendly because it's very simple terms. You also don't have a lot of these protective provisions. It can flip and be very detrimental if you have, say 2 or 3 rounds of safes or convertible debt because the math gets tricky and you might end up owning like way less than you think you own. So they're great for like that, hey, I just want to get this round closed, or I'm raising a friends and family round and I have $100,000 committed. I'm going to raise up to 300,000 and I just kind of want to leave it open so that other people can invest under that instrument. It's really good for those situations, but you don't want to you don't want to raise too many rounds in a row of those instruments.
Wonderful. Thank you. I think that touches on majority of the topics that were left in the chat. Once again, Jackie, thank you so much for your time. To Ryan and Phil, fantastic job being put in the spotlight. We appreciate you modeling that for all of us. For everyone tuning in, we'll be circulating the recording following this evening's session, and you can stay tuned for the survey as well in your inboxes tomorrow. Thank you all so much for tuning in. Jackie, thank you again for providing this content for us, and we hope to see you all on future events soon.
Awesome. Thanks for having me. And good luck.